It's late. The room is dark, the house is quiet. You open your investment portfolio and for a moment you stop breathing. $1,002,347. 7 digits, 2 commas, one number that represents years of deliberate sacrifice, disciplined decision-making, and delayed gratification. You did it. The Friday nights you declined, the vacations you deferred, the conversations where you quietly said not yet while everyone else spent freely, the automatic transfers, the low-cost indexed funds no one found exciting, the years of methodical, unglamorous consistency. You have crossed the threshold most people never reach. You feel something rare, not just relief, but a quiet, earned confidence. And then your mind begins to calculate. At a 7% annual return, $1 million generates roughly $70,000 per year without touching the principal. I could sustain this. I could breathe. And that is precisely when everything changes. The shift. Not with fanfare, not with ceremony. Subtly, systematically. Your digital advertisements change overnight. Suddenly, you're seeing exclusive wealth management solutions, tax optimization for high net worth individuals, and invitation-only financial products. Your bank representative calls to discuss premium services you now qualify for. And perhaps most powerfully, your own internal voice begins to shift. You've earned this. A more comfortable home, a safer, more refined vehicle, a private investment opportunity, a sophisticated tax strategy your network is raving about. When you had nothing, these offers didn't exist. At $50,000, the financial industry barely acknowledged you. But at $1 million, you become a client, a prospect, a market. The uncomfortable truth. Here is what most financial content will never tell you. Reaching $1 million is statistically exceptional. Federal Reserve data consistently shows that a significant majority of American households cannot absorb a $400 emergency without borrowing. The median retirement savings for Americans approaching retirement age remains alarmingly insufficient. If you have accumulated $1 million in investable assets, you have achieved something genuinely rare. But rarity does not confer immunity. In fact, at this level, it creates exposure. Because when you have spent years operating from scarcity, your psychology is primed for relief. Your brain, after years of discipline and sacrifice, begins searching for evidence that the sacrifice was worth it. It wants reward. It wants permission. And that neurological shift is precisely when 3 forces emerge. Forces that don't appear on any financial statement, that carry no official name, and yet collectively represent the most reliable pathway to quietly losing everything you've built. We call them the 3 silent taxes. Disclaimer. My name is Helen. This channel is dedicated to exploring how money actually functions, not through motivational rhetoric or curated highlight reels, but through evidence-based financial education. Nothing in this video constitutes financial advice. I am not a licensed financial advisor. All content is for educational and informational purposes only. Please consult a qualified financial professional before making any significant financial decisions. Now, let's examine the 3 forces quietly working against your $1 million foundation. The phases. Before we address the taxes, it's important to understand the 2 phases that define most wealth-building journeys. Phase 1, the accumulation phase. You are resourceful, intentional, and focused. Every dollar is allocated with purpose. Expenses are tracked, investments are automated. Delayed gratification is not a philosophy, it's a daily practice. Phase 2, the stability inflection point. You reach $1 million. And here, without warning, the psychological contract you held with money begins to quietly renegotiate itself. Silent tax number 1, lifestyle inflation. Most people do not blow their wealth in a single dramatic event. They erode it incrementally, one reasonable-seeming upgrade at a time. We'll move to a slightly better neighborhood. It's just a more reliable vehicle. One international trip per year isn't excessive. It's only an additional $1,500 per month. Each decision viewed in isolation appears entirely justifiable. But consider the mathematics. Under the widely referenced 4% safe withdrawal rule, a $1 million portfolio sustains approximately $40,000 per year without depleting the principal over a 30-year horizon.
Now observe what a modest lifestyle upgrade actually costs annually. Upgraded mortgage payment, plus $1,500 per month to $18,000 per year. Vehicle upgrade, plus $800 per month to $9,600 per year. Insurance increase, plus $600 per month to $7,200 per year. Travel and leisure, plus $1,000 per month to $12,000 per year. Total additional fixed annual expense is $46,800. That figure exceeds your entire sustainable annual withdrawal before a single discretionary dollar is spent. You have not spent your $1 million. You have imprisoned it inside a lifestyle it was never designed to support. This is the first and most insidious form of wealth erosion, not catastrophic loss, but quiet, permanent, structural entrapment. The financial industry thrives during this phase. Banks do not profit from disciplined savers. They profit from upgraded mortgages, premium auto loans, and premium credit products. Your transition from frugal accumulator to confident spender is not an accident. It is engineered. Silent tax number 2. Behavioral decision cost. After years of restraint, a well-documented psychological phenomenon emerges: the desire for action. The discipline that built your wealth begins to feel like a constraint rather than a strategy. You want to participate, to engage, to leverage your position. This manifests as a private equity deal with a compelling pitch, a cryptocurrency allocation based on a trusted contact's recommendation, a friend's business venture with exceptional upside, a real estate syndication promising 12% annual returns with limited downside. The internal justification follows a consistent pattern. I can afford to risk $100,000. I have $1 million. This is calculated risk. But here is what behavioral finance research reveals. Vanguard's Advisors Alpha research demonstrates that investor behavioral patterns, panic selling, performance chasing, ill-timed entries and exits, reduce net returns by an estimated 1.5% to 2% annually compared to a simple buy and hold approach. The Dalbar quantitative analysis of investor behavior has, for over 2 decades, documented the same phenomenon. The average equity investor consistently underperforms the index, not because of market conditions, but because of human decision-making. On a $100,000 portfolio, a 2% annual behavioral drag translates to $20,000 lost per year, every year. Compounding. Over 2 decades, the cumulative cost is not $400,000. Because of compounding, it is significantly more, often exceeding $700,000 to $1 million in foregone wealth. The market did not take that money. Emotion did. Silent tax number 3. Structural complexity cost. At some point in the journey from $1,000 onward, well-meaning professionals and occasionally less well-meaning ones will advise you that your wealth now requires sophistication. Suddenly, your financial life involves multiple custodial accounts across institutions, an estate attorney, a tax advisor, and a wealth manager operating independently. Alternative investment allocations, private credit, hedge funds, structured products, tax loss harvesting platforms with recurring subscription fees, premium credit products marketed as perquisites but structured as revenue generators. You feel organized, credentialed, advanced. But here is the empirical reality. Complexity creates friction. Friction creates errors. Errors generate fees. Fees compound silently against you. Consider the mathematics of a standard 1% annual advisory fee. Portfolio value, $1 million. Annual fee, $10,000, 30-year cost, at 7% growth, $900,000 plus foregone. Portfolio value, $2 million. Annual fee, $20,000. 30-year cost, $1.8 million plus foregone. This is not a crash. This is not a fraud. This is the quiet, legal, contractually agreed upon transfer of your wealth to someone else in exchange for complexity you may not need. Research consistently supports a counterintuitive conclusion. For the vast majority of investors, a low-cost, diversified, passively managed portfolio maintained consistently over decades outperforms actively managed, fee-laden alternatives net of all costs. Simplicity, historically, has been the most sophisticated strategy available. The compounding cost of all three taxes combined. Let us quantify what these three forces cost over time. Scenario A. Disciplined stewardship. $1 million invested at a net 7% annual return over 20 years grows to approximately $3,869,684. Scenario B, subject to all three taxes, $1 million at a net 5% annual return over 20 years grows to approximately $2,653,298. The difference, over $1.2 million. Not lost in a market crash, not stolen in a fraud, lost through the accumulated weight of lifestyle inflation, behavioral decisions, and structural complexity. Three forces that feel entirely reasonable in the moment and devastating in the aggregate.
The story of Alex. Alex reaches $1 million at age 45. Having spent years watching peers outpace him socially, Alex makes a series of decisions that feel earned and overdue. He relocates to a neighborhood that better reflects his new status. Property taxes increase substantially. Social expectations follow. He allocates $200,000 to a private investment that comes highly recommended. The investment underperforms significantly. During a market correction, he liquidates positions temporarily to preserve capital and re-enters the market after a partial recovery. 5 years later, Alex remains wealthy by conventional measures, but he is working harder than his plan required. His obligations have expanded beyond his portfolio's capacity to support them passively. His $1 million did not purchase freedom, it purchased a more expensive version of the same obligations. The story of Jordan. Jordan also reaches $1 million at age 45. Jordan makes one foundational decision. $1 million is the floor, not the ceiling, not the finish line, the floor. Jordan's annual living expenses remain at $70,000, consistent with the years prior. The portfolio remains predominantly in low-cost, diversified index funds, no dramatic reallocation, no premium products, no private deals. Jordan establishes two clear capital layers. The security layer, permanently protected, never touched, never optimized aggressively. This is the foundation. The growth layer continues compounding, allocated with discipline and consistency. A decade passes. Markets fluctuate as they always have. There are corrections, recoveries, periods of volatility. Jordan's net worth approaches $2 million, not because of exceptional investment acumen, not because of access to exclusive opportunities, because the base was protected. Work became optional. Time became the primary asset. Options expanded in every direction. The data supports this outcome consistently. Households that maintain low-cost, diversified portfolios and resist behavioral drift systematically outperform those that pursue complexity and yield chasing, net of all costs and adjustments. The framework, your 5-principle playbook. Principle 1. Define and protect the floor. When you reach $1 million, establish a clear psychological and financial boundary. This is the minimum, not the signal to expand obligations. Your lifestyle must not scale with your net worth. Principle 2. Maintain structural separation. Organize your capital into 3 distinct, clearly bounded allocations.
Security capital, protected, conservatively invested, never touched. Growth capital, long horizon, low cost, diversified, left to compound. Discretionary capital, a defined, limited allocation for higher risk opportunities or personal rewards. Never allow these allocations to merge or redefine each other. Principle 3. Index your spending to income, not net worth. Lifestyle increases should be tied to sustainable, recurring income, not a rising portfolio balance. A rising balance is not permission to increase fixed expenses. Principle 4. Subject every premium offering to a single question. Does this product increase my financial freedom, or does it increase my financial obligations? If the answer is the latter, decline, regardless of how sophisticated or exclusive it appears. Principle 5. Reorient around the true objective. The goal was never the number. The goal was options, time, the capacity to make choices from a position of security rather than necessity. $1 million is not a trophy. It is not a signal to the world. It is not permission to relax the principles that created it. It is infrastructure, and infrastructure, neglected, deteriorates. Closing. The financial industry is not inherently malicious, but it is built to serve its own interests, and those interests are best served when disciplined, asset-holding individuals begin to believe they deserve complexity, comfort, and premium access. The 3 silent taxes, lifestyle inflation, behavioral decision cost, and structural complexity, do not require a market crash to operate. They require only the entirely human desire to finally exhale after years of discipline. Your first $1 million is not the end of the game. It is the beginning of a more consequential one where the rules are subtler, the risks are quieter, and the cost of complacency is measured not in dollars lost, but in decades of compounding forfeited. Protect the foundation, resist the drift, stay boring. Because in wealth, the strength of everything above depends entirely on the integrity of what lies beneath.